Good evening, everyone, and thank you for joining us for the 2023 Hayek Book Prize and Lecture. I'm Reihan Salam, president of the Manhattan Institute, and I wanted to start the evening by explaining exactly why this prize is so important to us. The Hayek Prize is a celebration of Friedrich Hayek, one of the most consequential thinkers of the modern era. A celebrated economist who was awarded the Nobel Prize in 1974, Hayek did more than just make intellectual breakthroughs. He inspired a generation of economic reformers who helped liberate countless millions from poverty around the world, and his message remains vitally important as we look to the future. In his 1944 book, The Road to Serfdom, Hayek drew a connection between economic liberty and freedom more generally, arguing that government control of economic decision-making paved the way to further encroachments on individual rights. In The Use of Knowledge in Society, a groundbreaking article published in 1945, he carefully and methodically dismantled the logic behind economic collectivism. At a time when the world's intellectual elite was convinced that state socialism was the wave of the future, Hayek saw it for what it was, a seductive illusion that would cause untold misery. I'm proud to say that Hayek played a role in the formation of the Manhattan Institute. One of our founders, Sir Anthony Fisher, a successful entrepreneur, once asked him how to reverse the erosion of freedom. Hayek urged him to invest in the battlefield of ideas, and we continue that essential work today. We at the Manhattan Institute are dedicated to building on Hayek's legacy, and this prize is the crown jewel of those efforts. Each year, we award $50,000 to an author who continues in the Hayekian tradition of rigorous thought, clear communication, and respect for the liberating power of free markets. Tonight, we will hear from the 2023 Hayek Prize winner, Edward Chancellor, author of The Price of Time, who will be introduced in just a moment by my distinguished colleague, John Tierney. Before I turn things over to John, however, there are several people I'd like to thank for the support and hard work that goes into this prize. None of this would be possible without the support and friendship of Manhattan Institute trustee Thomas W. Smith, who first conceived of the prize, and Diane Smith. Together, they have supported the prize since its inception. Please join me in thanking Mr. and Mrs. Smith for their generosity and commitment to the cause of freedom. In addition to Mr. Smith, we have a number of other Manhattan Institute trustees who've kindly joined us tonight. Ann Charters, Ravenel Curry, Michael Kaufman, Nick O'Neill, and Russell Penoyer. We're also honored to have Larry Mohn, our President Emeritus, with us tonight. Thank you for all you do in support of our work. I'd now like to recognize the Hayek Prize jury, the distinguished women and men who carefully read each nominated book before selecting the winner. This year's jury included Brian Anderson, Don Boudreau, Thomas Easton, Catherine Mangue-Ward, James Pearson, Amity Schlaze, John Taylor, and last but not least, the chair of the jury, John Tierney. As many of you know, John is a contributing editor at City Journal and one of the nation's most renowned science journalists. A best-selling author known for his keen ability to make complex ideas engaging and accessible, he is a Hayekian through and through, and the perfect steward for this important prize and its important mission. With that, please welcome John Tierney to the stage.
Thanks very much, Reihan. And thanks to all of you for braving the unfriendly skies to be here tonight. On behalf of the Hayek Prize jury, I can promise you that we're in for a treat. We're going to hear from an author with an extremely rare gift. You know, there's a common lament in the book business that was once nicely summed up by a friend of mine. When you're working on a book, he said, you never know whether it will end up being published too early or too late, but it will definitely be one or the other. Now, this has never been a problem for Edward Chancellor. His books come out just in time for the world to say, My God, he was right. In his first book, A History of Financial Speculation, titled Devil Take the Hindmost, he warned in 1999 that the surge in dot-com stocks had all the earmarks of earlier financial manias, and next year the dot-com bubble burst. Later, he published Crunch Time for Credit, warning that the housing and credit bubbles would burst disastrously, and sure enough, they promptly did, leading to the financial crisis in 2007 and then the Great Recession. So early last year, when nobody worried about bank bailouts, when the Federal Reserve was still blithely keeping the interest rate at zero, he went to press with his latest book, The Price of Time, The Real Story of Interest. He warned that we would pay a hefty price for the Fed's irresponsible and unprecedented decade of easy money. And sure enough, here we are with headlines about failing banks, about collapsing pension funds, and fears of an even worse financial crisis ahead. His book is remarkable not only for its prescience, but also for its erudition and its flair. It's another of his rare gifts. He makes interest interesting. He even makes it funny. Above all, he makes it relevant. He shows that, just as Hayek warned, manipulating interest rates is the most dangerous form of central planning because it occurs very subtly, but it distorts the entire economy, and it leads to so many problems that are not subtle, from unaffordable housing to worsening income inequality. He clearly explains how the Fed's policies have fueled the populist anger in both political parties right now by rewarding reckless investors, financial gimmickry, and giant corporations at the expense of small businesses, workers, and retirees. As the book traces a long history of money lending, Chancellor deftly shows how rulers and bankers and investors keep making the same mistakes and keep ignoring Hayek's wisdom. Now, Hayek was one of those authors whose books appeared too early. He did have that one surprise bestseller in the 1940s, The Road to Serfdom, but intellectuals and politicians were so enthralled with socialism and central planning that it took decades for him to be vindicated. Nationalized industries foundered, and the Soviet Union eventually collapsed due to what Hayek called the fatal conceit. That's a delusion of central planners that they know enough to direct the economy. Hayek recognized that this fatal conceit afflicted the Federal Reserve and also other central bankers. But on this issue, he was really ahead of his time. During the 1920s, when central bankers were confident they could keep the economy stable and the stock market rising, Hayek warned that their manipulations of interest rates were distorting markets and would ultimately produce an ugly bust. Now, other economists poo-pooed this possibility, including Hayek's famous intellectual sparring partner, John Maynard Keynes. As Chancellor recounts, Keynes was so convinced in the late 1920s that experts had figured out how to smooth the economy and avoid busts that he just kept on investing in the stock market, and he lost 3/4 of his net worth when the roaring 20s came to a crashing end. Well, Hayek knew better, but his monetary theories are still ignored by most modern economists. Chancellor's book reminds us that Hayek's ideas are more important today than ever, and so do the other 5 books that were finalists for the prize. The Next American Economy by the eminent political economist Samuel Gregg draws eloquently on Hayek and the nation's founders to offer a practical and also an inspiring strategy to defend free markets and free trade against the populists in both parties. I wish every presidential candidate would read it. And I'd like to salute Sam, who is with us tonight, for just writing a great book. I'm not sure where. Okay. Another finalist, Bruce Caldwell, who's a previous winner of the Manhattan Institute's Hayek Prize for Scholarship, has teamed with Hans-Jörg Klausinger to offer a wealth of surprising new insights about Hayek's early personal and intellectual struggles. We look forward to the concluding volume of what is sure to be the definitive biography of Hayek. 40 years ago, Hayek championed the economist Julian Simon and other optimists convinced that the world was not running out of natural resources. Their optimism has been confirmed decisively by the rigorous research of Marion Tupy and Gail Pooley in Superabundance, a book that joyously refutes doomsayers by showing just how much better life is becoming for people around the world. Another finalist, the journalist Matthew Hennessy, has written a witty and breezy economic primer titled The Visible Hand. If you want to convert the many young people who doubt the virtues of free markets, give them this delightful introduction to basic economics. And if you want to understand how a city can thrive without the guidance of master planners, take a look at Emergent Tokyo. This beautifully illustrated book shows how Tokyo became so vibrant and livable through the process that Hayek called spontaneous order. Our winner tonight joins us from England, where he was born and raised. After earning a degree in modern history at Cambridge and a master's degree in Enlightenment history at Oxford, he went on to work as an investment strategist in London at the Lazard Brothers Bank, and later at the GMO investment firm in Boston. In between those stints managing money, he's been writing about it. During the last financial crisis in 2008, his article on Institutional Investor won the George Polk Award for financial reporting. He's edited 2 very well-received investment books, and his financial histories have been translated into half a dozen languages. He's currently a columnist for Reuters and contributes to the Wall Street Journal, Money Week, the New York Review of Books, and the Financial Times. I must add one other biographical detail. When I wrote to him to inform him that the Hayek jury had chosen his book, here's what he wrote in response. Quote, "I was over the moon to be nominated for the Hayek Prize without any expectation of further honors. And actually winning the prize brings tears to my eyes. Only this morning I was reading extracts of Hayek's Road to Serfdom to my wife, saying that what he says applies exactly to what one can see now, the same mindset among the expert class imposing their priorities on the people." Close quote. I ask you, could there be a more worthy recipient of this award than an author who reads The Road to Serfdom to his wife at breakfast? Somewhere Hayek must be smiling. Ladies and gentlemen, please welcome Edward Chancellor, the winner of the 2023 Hayek Book Prize.
Thank you, John. I think tears coming to my eyes again. I am, as you say, deeply honored to be standing here and delighted that the prize I'm receiving today is named after Friedrich Hayek, a hero of mine. But let me start with some word of thanks. I'd like to thank the Manhattan Institute and John Tierney and the other judges for selecting my book for their generous prize. And my publisher, Morgan Entrekin at Grove Atlantic. You can't hear me? Sorry. And I'd like to thank my publisher, Morgan Entrekin at Grove Atlantic, for taking up my book after my former US publisher, Farrar Straus, turned it down on the grounds it was too difficult for a trade audience. And my UK editor, Stuart Profit of Penguin, who on accepting the book wrote that its, quote, neo-Hayekian conclusion is both powerful and persuasive. And my wife, Antonia, who's described in the acknowledgements as my in-house editor, but is also a lot more. The early 19th century banker, Henry Thornton, author of a classic work on monetary economics, an inquiry into the nature and effects of paper money, wrote to his sister that working on the book had been a hard fag. I know the feeling, and Antonio saw me through many years of hard fagging, which in English means enduring hard work. I was thrilled to be shortlisted for the Hayek Prize, but didn't think I had much chance, since among the other books on the shortlist was the definitive biography of Friedrich Hayek by Bruce Caldwell and Hans-Jörg Klausinger. As is the case with anyone who has interested himself with Hayek in recent years, I owe Bruce Caldwell a huge debt for his editorship of Hayek's works. My introduction to the Austrian economist came from reading Caldwell's intellectual biography, Hayek's Challenge, some 2 decades ago. Since we await a second installment of the Hayek biography, Caldwell and Klausinger at least will have a second chance. I first became interested in Hayek after I was commissioned to write a report on the ongoing credit boom of the early 2000s, later published, as John mentioned, under the title Crunch Time for Credit. It was curious to observe an epic credit bubble forming with associated bubbles in real estate in the United States and Europe, which the central bankers studiously ignored. So obsessed were they at the time with meeting their inflation targets that nothing else appeared on the radar. Both Keynesian and monetarist economists, Milton Friedman was still alive at the time, supported the Fed's policy. Under Alan Greenspan, the easy money policy was inaugurated and the Fed funds rate was reduced to 1%, a post-war low, in 2002. As long as inflation remained under control, we were told, nothing could go wrong. The Bank of England developed an acronym at the time called NICE, Non-Inflationary Consistent Expansion. The pursuit of price stability, what we now call inflation targeting, became popular in the 1920s. Many of the world's leading economists at the time, Maynard Keynes, Irving Fisher of Yale, the Swede Gustav Cassel, Rafe Hawtrey at the British Treasury, supported this policy. In 1933, Irving Fisher wrote his enormously influential paper, The Debt Deflation Theory of Great Depressions, which argued that the debt deflation was the primary cause of the 1930s depression. Milton Friedman and Anna Schwartz continued this argument in their Monetary History of the United States and in their short book, The Great Contraction. These views are summed up by a comment of Schwartz in 1995 that, quote, monetary stability is a prerequisite for price stability, and price stability is a prerequisite for financial stability. The young Hayek, who studied the Federal Reserve's policy at NYU when he visited New York in the early 1930s, and as Caldwell and Klausinger tell us, was forced to earn his money washing dishes, criticized the monetary authorities' attempt to keep the price level stable. In an economy with strong productivity growth, as was the case in spades for the US in the 1920s, prices have a natural tendency to decline, he said. In fact, if you think about it, the entire nature of a capitalist system is to generate productivity, which, everything else being equal, should bring down the price level. Any attempt to resist this movement required the central banks to keep interest rates unnaturally low, below what economists call the natural rate of interest. Credit newly created by commercial banks then takes the place of genuine savings. This involved what Hayek called forced savings and the hidden inflation of the credit boom. Such policies in the short run could succeed in delivering an unchanging price level, but they were doomed to failure. Eventually, interest rates would have to rise to curtail inflation, and the boom would give way to a bust. Hayek also argued, expanding the theory of interest propounded by Eugen von Böhm-Bawerk, the author of the lengthy 3-volume work Capital and Interest, which I'm the only person in the room to have read cover to cover, taking me several weeks in the process. And Böhm-Bawerk, who was also his maternal grandfather's climbing companion, argued that manipulating the rate of interest would change the structure of production in an economy. Lower interest rates would lead to investments whose profits lay in the more distant future. When the bust arrived, such investments would prove unviable. They would become what we would now call stranded assets. In his early days, Hayek emphasized that all economic activity takes place over time. This is a very important insight of Hayek's. He understood that that interest served to coordinate economic activities across time and introduce the notion of intertemporal disequilibrium. The pursuit of price stability at a time of a positive supply shock, as Hayek wrote in 1928, quote, administers an excessive stimulus to the expansion of output as costs of production fall, and thus regularly makes a later fall in prices with a simultaneous contraction of output unavoidable. In other words, by trying to avoid the good deflation produced by productivity growth, we bring about the bad deflation of a credit bust that Fisher, Friedman, and others deplored. We can argue whether Hayek anticipated the Great Depression. Caldwell and Clausinger suggest that this is a myth, or at least an exaggeration. But clearly he understood that all was not well with the stance of the US monetary authorities in the 1920s. What I find most remarkable is that Hayek's interpretation has been airbrushed from the monetary histories of the period. There's no mention of it in Friedman and Schwartz, and nor in Alan Meltzer's lengthy 3-volume history of the Federal Reserve. In 2005, I wrote a paper for a collection of essays on monetary theory, commissioned coincidentally by the Institute of Economic Affairs, a sister institution of the Manhattan Institute, in which I argued that we were living through a great experiment in inflation targeting, an experiment which would either have a benign outcome, in which case Friedman would be vindicated, or end in a bust, which would lend support for Hayek's theory. This paper went out to a peer reviewer whose snide comment was, if members of the Austrian church wish to be heard, it behoves them to relate more to the mainstream. I decided to withdraw my paper. At roughly the same time, Bill White of the Bank for International Settlements published a paper, Is Price Stability Enough?, which contained a similar argument and was laced with references to Hayek. The answer to this question, as the world would shortly discover, was a resounding no. In my view, the global financial crisis proved an extremely expensive vindication of Hayek's monetary theory. Not that you'd find that view expressed, as far as I know, in any of the hundreds of books published in the aftermath of the crisis. And because the monetary authorities didn't learn this lesson from the crisis, they decided that the cure for the Great Recession was more of the same. So they took interest rates to their lowest levels in 5,000 years and into negative territory in Europe and Japan, an unprecedented development, and bloated the central banks' balance sheets with trillions and dollars worth of quantitative easing. The second half of my book, The Price of Time, examines the unintended consequences of ultra-low rates in the post-Lehman era. My feeling was that modern economists had developed a narrowly technocratic view of interest, which they saw as a policy lever that could be toggled up and down in order to control inflation. In my view, the use of interest as a policy lever is just one of the several roles that interest plays, and possibly the least important one. Let me give you a few others. Interest is also the capitalization rate or discount rate used to value assets. It incorporates the time value of money or investors' time preference. As Hayek's mentor, Ludwig von Mises, put it, without a discount rate, an apple in 100 years' time would be worth the same as an apple today, an obvious absurdity. As I show in the book, speculative bubbles have proliferated in periods of easy money, from the Dutch tulip mania of the 1630s through to the everything bubble that finally burst last year. Interest also influences the allocation of capital, Hayek's structure of production. Ultra-low rates slowed the tempo of production, as Jim Grant, another winner of the Hayek Prize and here today, pointed out. Low rates trap capital in zombie companies, encouraging investment in pie-in-the-sky ventures, such as the billion-dollar unicorns of Silicon Valley As Jim wrote several years ago, it is a little-known fact about unicorns that they feed on interest rates. They like low, little rates. The tinier, the better. Now, you may have noticed that many of those unicorns were then swallowed up in 2020 by these special purpose acquisition companies, or SPACs, one of the most glorious speculative episodes in financial history. I saw a comment a few months ago by the so-called SPAC king, Chamath Palihapitiya, who said, "The mathematical truth of higher interest rates is that it renders your company valueless." Well, perhaps it didn't really have much value to start with. Interest is the price of leverage, or the price of anxiety, as the 18th century philosopher Ferdinand Galliani put it, or what we would call the price of risk. Without interest, leverage climbs to the sky and risk-taking proliferates. John Bull can stand many things, but he cannot stand 2%, wrote Walter Bagehot, the great Victorian financial journalist. And modern research confirms that when interest rates fall to abnormally low levels, investors take on more risk. Interest is a reward for abstinence, an inducement to save. Not only do we save more when interest rates are higher, but savers enjoy higher returns. The low rates of recent years have created a permanent pensions crisis and led the UK pension funds to take extraordinary risks, leveraging up long-dated index-linked gilts at negative yields. The level of interest determines capital flows, driving capital into emerging markets when they're low at the center, at the financial center. And interest is the lifeblood of banking. As PIMCO's Bill Gross pointed out a decade ago, a healthy carry is necessary for banks to engage in maturity transformation, borrowing short and lending long. Gross at the time compared carry to the oxygen that feeds the blood. At zero interest rates, he wrote, the blood becomes anemic, oxygen-starved, even leukemic. Safe carry, he said, was essential to capitalism. So in the last year, we have seen the consequences and fallout of rising off the lowest interest rates in history. $30 trillion wiped off the global bond and stock markets last year, the crypto winter emerging, and the collapse of Sam Bankman-Fried's much lauded FTX crypto exchange, an event that called to mind Walter Bagehot's dictum that all people are most credulous when they are most happy, and when much money has been made, when some people are really making it, when most people think they are making it, there is a happy opportunity for ingenuous mendacity. And earlier this year, we saw the collapse of the Silicon Valley Bank, several other banks who searched for safe carry in supposedly risk-free US treasuries came unstuck when interest rates rose. In my view, the ultra-low interest rates have undermined the balance sheets at every level, government, corporate, and household. Asset prices became excessively inflated, too much leverage was assumed, creating a state of fragility throughout the financial system. The misallocation of capital, whether in zombie companies, tech ventures, or simply real estate, has contributed to the collapse of productivity growth. Since 2008, UK productivity growth has been running at less than 1/3 of that achieved in the Industrial Revolution in the late 18th century. From a Hayekian perspective, it's fair to say that the ultra-low rates have pushed the economy into a state of intertemporal disequilibrium. In The Road to Serfdom, Hayek argued that inequality is generally acceptable when differences of outcome are seen to be fairly earned or at least at random. He believed that inequality wouldn't be acceptable when it arose because of government policy and favored specific groups. Yet ultra-low interest rates have benefited certain groups in societies, the so-called haves, financiers, senior corporate executives, older people, while disadvantaging other groups, ordinary people with most of their savings on deposit, those still saving for retirement, and the younger generation. Hayek also argued that political stability depended on the existence of a strong middle class, and that capitalism democracy depended on economic growth. In my view, the ultra-low rates have weakened the middle classes, pushing up the cost of retirement and housing, and have impeded economic growth, thereby undermining the general public acceptance of capitalism. Hayek identified how problems arise when the authorities seek to achieve stability, for instance, by keeping unemployment down at all costs. As he wrote, the more we try to provide full security by interfering with the market system, the greater the insecurity becomes. And what is worse, the greater becomes the contrast between the security of those to whom it is granted as a privilege and the ever-increasing insecurity of the underprivileged. As I say, The Road to Serfdom appears more relevant today than when it was first published in 1944. Hayek understood that central bankers set themselves an impossible task when they try to gauge the correct rate of interest. After all, as Irving Fisher said, interest is an omnipresent phenomenon. Instead, as I mentioned, the central bankers rely on short-term inflation to guide their monetary policy decisions. But as Hayek demonstrated, this can turn out to be a dangerous prop to depend upon. My final point is that central planning is back, not just in monetary policy, but in other areas, public health and lockdowns, planning for an energy transition. In certain ways, the planners are more dangerous today than they were in the 1940s, because this time they come armed with computers and spreadsheets. Once interest rates no longer guide the allocation of capital and set asset allocations at fair prices and restrain risk-taking, central bankers step up to take their place. Hence, central banking in recent years has involved itself in corporate governance in Japan, in credit allocation in Europe, and more recently in green financing and social justice. There's no apparent end to the process. This constitutes, to my mind, a new road to serfdom. Hayek's key point, as I see it, is that when planners interfere excessively in a complex evolving system, such as the modern capitalist economy, no good will come of it. That explains why he supported the gold standard long after it had gone out of fashion. The attraction of the gold standard was that it kept the money supply finite rather than created by central banks and commercial banks, and allowed more or less for the market to set the rate of interest. Half a century has passed since the collapse of the Bretton Woods system, the last vestige of a gold-backed monetary system. And the experience of fiat money in recent years has not been heartening. An apparently endless sequence of financial crises, asset price bubbles, slowing productivity growth, rising inequality, and now rising inflation. I wonder how long the current arrangements can last. It's possible that a new monetary system will arise, perhaps one based on digital currencies, akin to Hayek's denationalization of money, or one based on a central bank digital currency whose growth is limited by design, a digital gold standard, so to speak. If that happens, then the job of setting interest rates will no longer be given to a group of highly qualified men and women sitting around a table in the Eccles building in Washington, D.C., the home of the Federal Reserve. And that, in my view, won't be a bad thing. Thank you.
Mr. Chancellor, we'll take some questions now.
Okay. Yeah, right at the front.
Thank you very much for the lecture. It's wonderful to have someone present an argument so powerful, so clearly. I was going to ask you about Bombarek, if I'm pronouncing that right. He said a nation's interest rates reflects its culture. I don't want to put you on the spot, but I would be very interested in what you thought of our culture. Thank you.
Well, no, I mean, that it is an interesting book because if one were to take that comment of Bern Barwek at face value, you would say that we have been the most civilized society in the entire history of civilization because we've had the lowest interest rates. So the more I thought about that, the more I thought, well, perhaps not. But the argument, the original argument, and this is not just Bern Barwek, this is an observation that was seen, that was mooted in the 17th century when people looked at, for instance, the Dutch Republic, and they saw that the Dutch had the rule of law, they had developed capital markets, and they had large savings, and they had the lowest interest rates in Europe. So that was when the idea first came about. I think in recent years, as I've been arguing in the book and mentioned just now, is that the interest rates we see are not really the interest rates properly reflective of our civilization or what the Austrian economists would call our time preference. They are artificial interest rates. There is another point I mentioned in the book, is that civilizations also go through this sort of U-shaped period of interest rates, where when a civilization establishes itself, it has high rates, and then they fall during the course of civilization. Then when the civilization comes to an end, they start rising rapidly. So I don't think one can become overly complacent about the very low interest rates one had in recent years.
Yes, the mainstream financial press has pretty much disparaged the idea that cryptocurrency has any place in the world. But is it possible that it grew out of a mistrust of what the central banks were doing, and that in fact the conditions exist now more than ever for the creation of a market-based currency?
I mean, yes and no. I would say, I mean, as far as I understand, that the first, the Bitcoin was launched just after the Lehman bust, and it was launched, the justification at the time was the central banks printing a lot of money, and therefore, the crypto might be the way forward. I think the problem is that the cryptocurrencies became the greatest, and the bubble in cryptocurrencies was the greatest symptom of the monetary disorder of the last 15 years or so. And without getting into a huge debate on the subject, for my mind, the cryptocurrencies don't, at least as currently constituted, have sufficient number of the attributes of money to actually to actually succeed, and instead have just really been a barometer of speculation. But that isn't to say that at some stage a type of digital currency couldn't establish itself, and therefore, as I say, remind one of the type of competing private currencies or monies that Hayek advocated in the denationalization of money. I mean, I've done a lot of work on speculative bubbles, and one tends to sort of laugh at the early stages or the early emanations of something of the bubbles, but sometimes the technology comes back at a later stage, and the bubble is really just sort of trying things out and seeing what will work. So we'll have to see.
Could you take us on a world tour and tell us where we would find the most responsible monetary policy and the least responsible monetary policy?
Yeah, I mean, it's a difficult question. I think the Japanese came very late to negative rates, and they became, particularly fanatical. It was only, I think, in 2016 the Japanese rates turned negative, and it was only. And I think the Japanese have sort of gone further, and as you probably know, they kept their interest rates negative for longer, and they carried on expanding their balance sheet. So I would probably award the prize for the most irresponsible central bank to the Bank of Japan. There aren't very many prizes, as far as I can see, for the best central bank. I like what Iceland has done in the aftermath of the global financial crisis, because really Iceland was just too small and no one came to its rescue. So that actually the Icelanders had to have, they had to clean out their financial system and had high rates. I think some of the emerging markets, not China, but some of the emerging markets have really been forced to have higher rates and therefore probably, a bit more robust. But then, there are the normal basket cases of Argentina and never-ending crisis in Turkey. So there are very few models that you would like to hold up, I'm afraid. Any other questions?
Can you elaborate on the relationship between interest rates and stagnant productivity?
Yes. So there are two ways in which I can answer that question. One is go back, starting with the argument made by Hayek's slightly older Austrian contemporary, Joseph Schumpeter, and Schumpeter arguing that the economy is a dynamic, evolving system, and that creative destruction is the most important feature of a capitalist economy. So if you and Schumpeter also argues that the rate of interest enters into every calculation. And if you arrest the process of creative destruction by taking interest rates down to very low levels, then businesses that would otherwise have failed continue to exist. And what we find, and I read there's some papers from the OECD suggesting that where these so-called zombie companies, and zombie companies are unprofitable companies that can't even pay, they don't even generate enough profit to pay their interest charges, even at very low rates. And the zombie companies appear to, when they exist in any particular sector, they appear to discourage new business entries, which is pretty obvious because there are other businesses there, discourage investment, discourage jobs growth, and are characterized by low productivity growth. So I think that if you arrest the creative destruction, what we did see for all this talk of the Great Recession, what we find is that actually insolvencies were lower after 2008 than they had been after the two previous recessions. So I think there was an arresting of the process of creative destruction, and then the allocation of capital in businesses that don't generate productive returns, or the misallocation of capital, or to use the Austrian term, malinvestment. So if the rate of interest serves to guide capital or to ration capital so that it's used well, then you will generate, or you might hope to generate, productivity growth. But if you set the rate of interest at a level in which capital, to all intents and purposes, appears free, then actually I think you get a misallocation of capital and low productivity growth. But the central bankers or the conventional monetary policy makers would say things completely the other way around. They say that the low productivity growth is, to use a phrase of Ben Bernanke's, dovish for interest rates. In other words, that the lower productivity growth is driven, the lower interest rates go, until you get this sort of slightly unhealthy, vicious cycle. front here.
To follow up on your question, when you were asked to identify a central bank that got it right and had difficulty, why, given the force of your arguments, are the central banks so uniformly wrong, or were they so uniformly wrong?
Well, look, I mean, I'm trained as an economist rather than trained as a historian rather than an economist, and definitely not a monetary economist by training. My view is that central banking, monetary policy making has become very abstract, very model-driven, and the assumptions behind these within the models, embedded in the models, rational expectations and general equilibrium, and then these strange, they have these strange representative agents, the entire economy and represented by a single company or a single individual. They're so abstruse, these models, and so divorced from what we see in the real world that I think that they've led the central bankers into a sort of theoretical bunker that they don't really see what's happening. I mean, I'm not saying all of it. I think what's happened, particularly in the last, with the Fed and other central banks, is that was, if you remember, after the financial crisis, a bit of a tussle between the so-called doves, who wanted lower and lower interest rates, and the hawks. And the hawks really, lost the battle. The doves, despite being called doves, they actually ruthlessly exterminated all the hawks. and then this has led to suggestions of groupthink, and then this thing, I like the idea of cognitive dissonance, which is you just cannot see that which is not in your model. And I mean, if one was going to reform central banking, one of the things one would like to see is a genuinely intellectually diverse set of people, if the decisions have to be made in setting interest rates, and actually more people with practical experience, people who've actually worked in the real world. I think at the time of the global financial crisis, there was not a single member of the FOMC who had any practical banking or commercial experience whatsoever. It's extraordinary. Sorry? One last question. Okay.
Most of your comments have been directed to the impact of interest rates on the private sector, and I'm hoping you could comment more on their effect on government policy. For instance, when Steve Mnuchin, no fool he, was Secretary of the Treasury during the entirety of the Trump administration, he said it didn't matter how much the government borrowed and spent because interest rates were near zero.
Yes. Well, I mean, I did mention in passing that I thought that the low interest rates had destroyed every balance sheet, starting with the governments. And when money appeared free, then the governments went on tremendous spending spree. So U.S. government debt, and same and true of Britain, they roughly doubled their debt to GDP ratios, while at the same time the cost of borrowing, of funding, of debt service actually remained stable or actually slightly declined. And this problem has been exacerbated, the potential problem is exacerbated by this quantitative easing, because quantitative easing involved the central banks going out, buying fixed income government debt and replacing it with this floating short-term debt in the form of central bank reserves that pay interest. And what that means now is that the debt that appeared so free and so easy, and that our political masters amassed so negligently, is now the system is much more sensitive to even small changes in interest rates. The British government, for instance, was borrowing, in effect, via the Bank of England, in effect at 8 basis points cost of funding. And now, I don't know where the interest rates are today, but around 3.5% or thereabouts. You can see that the cost of financing that debt feeds through much more quickly. So, and the other thing I'd say, if you look at the lockdown policies, which really has to be one of the most ruinously expensive government policies ever instituted, admittedly for good purposes, I cannot think that money would have been spent with, as it was, unless it appeared to be free at the time. It's just an illusion, because the loss must fall somewhere at some stage, either to the taxpayers or to the government creditors, or through inflation to the public at large. I think that's it, for the time being.
Thank you very much for that great lecture. I want to thank again the Hayek jurors for reading so many books so well. I'd like to congratulate again all the finalists for producing great books, and I want to thank you all for coming. And I especially want to thank the Thomas W. Smith Foundation for making this evening possible, and for all that it does to make sure that new generations learn Hayek's wisdom. Thank you and good night.